Our game plan or our business model is very simple. We're deploying capital in new and interesting situations in the tech and life sciences sector. We might do growth buyout financing, growth equity financing. We could do some early stage financing, and we have the capacity also to do some selective debt financing. We partner with our partner companies in tech and life sciences and work to build value, and we realize that value with well-timed exits. That's the driver of the economic engine. We're not an operating company. This is revenue and EBITDA is not the way to measure the success of Safeguard Scientifics. Now, many people hear that and they say, well, Safeguard is a public venture capital vehicle, or Safeguard is a public private equity vehicle. There's some similarity, but there are many more differences. First of all, we don't play quite as early as the A-round venture capital community. We don't play quite as late as the private equity community. We're somewhat of an in-betweener. We're in early enough that we have a chance for a 10-bagger, but we're not in so early that we're going to face 40% of everything that we deploy as a goose egg, which is the A-round formula. 40% goose egg, 40% you're lucky if you get your money back, and 20% you're making money. That's not our formula. We provide operational support services to our partner companies. We don't fish for them, but we help teach them how to fish as they go and grow in their business. Now, recognizing that our people have operational experience at the C level, when we take board seats, we don't give advice based upon some case study we read in business school. We give advice based upon scars of experience on our backs, and that is usually valued to be much more helpful to growing a business. Now, from a shareholder perspective, you can put in a little bit or a lot. If you were a limited partner in a venture or a private equity firm, you also have two choices. You put in a lot or a lot more. Here, you have immediate liquidity. You don't have to wait several years for a distribution. There's plenty of liquidity. You can get in or out at any time, or in, out, and back in again at any time. And remember, this is New York Stock Exchange governance, so all of the transparency that comes with that, as opposed to cloaking everything we have with a great deal of secrecy. So lots of differences in the Safeguard model. And our business model is different. When we have an exit, any gain that we've had has been sheltered from taxes by our NOLs, and the money's been evergreened on our balance sheet. Hence, we're self-funding. To a management team, that says that we have a little bit more patience built into our model, and we're not likely to do a forced exit in a few years in order to return capital to limited partners and then raise a new fund every few years. So lots of differences in our model.